Hello and welcome to Switzer Investing. I'm Paul Rickard, filling in for Peter Switzer, who will be away for a couple of weeks, but I'll be in the hot seat. Now, great show today. We've got two guests, Grady Wolf from Bell Direct. We'll be catching up with her about what's been going on in the market, in particular Westpac's half-year profit result today. What does that mean? What does that mean for some of the other banks who are going to be reporting later this week? Followed up by Chris Haynes. Chris is the head of equities at Equity Trustees. A bit more about the longer-term impacts of the election on the markets and a couple of sectors and stocks that he thinks look like good value. Now, the election, I guess, for everyone was a surprise. I'm a bit like you. I was feeling, well, most of you, I guess, were probably a bit devastated by the result on Saturday evening. But the big impact of the election hasn't actually been talked about. We all know Albo's in, but the big impact for many investors is that the Senate now looks like capable of passing a lot of Labor legislation. And basically, Albo won't need to rely on a lot of pesky independent senators to get things through. So potentially, he may be able to be a bit more adventurous in his second term. In particular, the so-called super tax, that was a tax on for investors who've got super balances of more than $3 million, has been held up in the Senate now for 3 years. That could well and truly get through post the 1st of July. And here's why. The Labor Party went into the election with 12 senators. It looks like it's going to win probably 16, possibly 17. That takes a total to 28 or 29. The Greens went in with 5. They're going to win 6 seats. They're going to end up with 11 seats in their own right. To have a legislation through the Senate, you need a total of 39 votes. Well, ALP on 28, Greens on 11, that'll give you the 39 needed. So the holdout senators who've been stopping the $3 million tax, people like David Pocock, they're not going to be as relevant potentially in the new parliament. So that's going to have a big impact for super fund investors. Now, $3 million is well outside the reach of many people, but that $3 million is not going to be indexed. If the Greens have their way, it's actually going to be $2 million. So let's see how that plays out with the government. And then finally, it's introducing this really draconian measure of taxing unrealised gains. And that's really a precedent that I don't think Australia wants to go through. So that's, for me, is the biggest single piece of news out of the election, apart from the fact that Albo's now got a majority. And probably we're going to be better off with the majority government. At least there's more chance of a government being able to implement its policy and not having to worry about getting its legislation through, of all places, the House of Representatives. So that's for me on the election. I'm as surprised as you, but certainly the super tax, I think, is back on the agenda. Now let's get back to the here and the present and a little more focus on what happened today, and in particular with Westpac's half-year result. My first guest is Grady Wolf. Grady is a market analyst with Bell Direct.
Thanks for having me today.
Look, the big highlight today was Westpac's half-year result, probably a little bit below expectations, and the markets just sold it off a touch. What did you make of it, and what were the highlights in that result?
Yeah, I think they're looking at the interim dividend. That was one area that investors were quite disappointed with, albeit it was above last year's, but just below what the markets were expecting. And I think it's kind of a sign of the times. So what they're expecting in the markets at the moment is, I think, higher than what the valuations are saying. So valuations have elevated for our 4 big banks. Westpac has actually performed the second best of our big 4 over the last year, just behind CBA, as we know, which is very highly valued right now. The results of Westpac just kind of, they give a sign of the times. We're having slowing economic growth, having slowing growth on an earnings front. We have more competition in the banking space as consumers look for better and higher paying yields, as at the same time as lower mortgage rates in this current cost of living environment. So looking at their results, the first half net profit was down just 1% on the first half of last year, which was a much easier year to operate in. So I don't think it was a bad result today. I think the market was just expecting high things given the current valuations we're seeing for our big banks.
And why do you think that the market's been putting such a big premium on stocks like CBA and Westpac to a secondary extent?
Investors are looking for any safe haven nature right now in the market. So whether it be gold or the banks, because the banks in Australia are so heavily scrutinized and regulated that there's no way that they're ever going to go under. So with that in mind, investors are thinking, I can't go for risk right now because there's so much volatility in the market. Valuations have been escalating over the last year. We're at record highs in the markets earlier this year. We're getting back to that territory now, and we're seeing valuations go through the roof. So investors are really looking for that safe haven asset and safe haven nature in their portfolio and exposure, which our banks are definitely primed for. And that's what we're seeing why investors are piling into the banks, not so much for their results, but for the safe haven nature of these assets.
I think CBA is trading on something like 27 times its PE, and you look at CBA, the yield's now under 3%.
Yeah.
Maybe there's a little bit of growth there, but what you saw on the Westpac result was basically, profits are flat to falling, net interest margins are stable to coming down, and they're in a period also where bad debts are at record lows. So
Yeah.
it's just so hard to comprehend why people are buying them, isn't it?
I think, yeah, exactly. So when you're looking at the fundamentals and the financials of a company like this, it doesn't really scream buy opportunity to me at the moment. I know that, and that's why it kind of definitely says that the prime way and the prime reason that investors are buying in is the safe haven nature of our banks. As you said, net interest margins have peaked. Bad and doubtful debts are higher at the moment because investors are facing this high cost of living pressure. They're hoping for any rate cut possible. And I know of a lot of Australians have really pushed their budgets to try and keep their houses under control and their mortgages under control, but it's really, really tough going right now. So with slowing earnings on earnings front for all of our big banks and investors switching left, right, and center, I don't see the value in investing and buying in right now.
I think NAB reports its half year this
Yeah.
Wednesday, ANZ on Thursday, and I think CBA has a quarterly trading update next Wednesday. What are we looking forward to the other major banks?
I want to see CBA justify their share price. I don't know about you, but a 29 times PE is very, very high for our big banks. But I want to see how the net interest margins have fared across the board. We know Westpacs came down, and they have been coming down for a while now across the board because that's the way the banks make most of their profits. So while that is coming down, it says that growth potential in the banking space is coming down. So I want to evaluate across the board how net interest margins have fared to get a collective overview of the industry. I also want to see how NAB, obviously the number one business lender, how they performed in the business area. CBA number one for home deposits and for customer deposits. So I want to see how they've fared in their key advantage area. And obviously ANZ kind of lags a little bit, but I just want to see across the board measure the success and how they performed versus market expectations. Because we know Westpac slightly underperformed today, but that will justify the share price fall off today. But then again, I want to see how much CBA comes down if they do miss results next week.
And presumably, though, if interest rates are about to be cut, that actually should put a bit of pressure further on margins, shouldn't it?
Yeah, absolutely. So we see that obviously interest rates being cut, investors are looking for opportunities, not only elsewhere for their margins, but also elsewhere for better opportunities in the market. So as I said, switching is rising at the moment. So we'll see even greater switching because the banks are very quick to pass on the interest rate hikes, but are very slow to pass on the cuts. So, and on a deposit front, what you want to see is investors getting the best bang for their buck from all the banks out there. So I know Macquarie has done quite well in garnering some of the market share recently, and that's really boded well for them. But you look at the likes of CBA, Westpac, ANZ, and NAB, and the big four, and they're going to come under pressure even more in an interest rate cut environment.
Right. Now let's shift from banks to gold, which has also been pretty topical, but gold prices sort of steadying a bit. We saw some of the gold miners last week come off quite markedly. Was that just on the back of the gold price, or were there other issues at play there?
No, we had a few downgrade their production guidance output for the full year last week, and investors really hit that hard. They took the news very negatively. I think investors have been piling into any producers in recent times simply because they want to capitalize on the upside potential that we've seen in the gold price. And that has really fared well for our big companies out there, Regis Resources, Evolution, Northern Star Resources, all the big producers out there. But with Northern Star, I think it was an Ora Banda as well, reducing their full year guidance of production output. Investors investors weren't too impressed with that, especially on the back of a recent share price appreciation. So while the gold price coming down has definitely fared into and kind of played a part in the share price depreciation recently, it was more due to the output cut of a number of our big gold miners. But then again, today we have Gold Road Resources up 9%. I think that was on a production guidance update. So yeah, it's a really mixed bag at the moment, but I think investors are seeing gold as a safe haven asset, as I mentioned earlier, and they're looking for those key safe haven value opportunities right now.
It seems to me that gold's one of those things, particularly gold stocks are one of the things to buy when you think the gold price is about to zoom higher because of the leverage. But maybe if the gold price has already moved, it may be time not to think about it. You've got extra risk, just the mining risk. But for those who want to buy a gold stock, is there one that you at Bell really like at the moment?
Yeah, Bells have a buy rating on Gold Road Resources, and we've recently downgraded Regis Resources to a hold. So our analysts are really they're keeping a close eye on more than ever on their evaluations right now because share prices are moving so quickly. So they're looking at the ones with the high grade output, low all-in sustaining costs, and ones that are already producing. So you don't want the risk of a miner that isn't producing yet, that's still in the drilling phases, but there is upside potential, especially with the speculative risk that you've got there. But when you're in production right now, so as I mentioned, Evolution Mining they have a number of different mines, so that geodiversifies them at the same time and obviously offers some different reserves and revenue out there. But they have copper exposure as well. So having diversified commodity exposure as well, especially when copper's on a run right now, that's what we're looking for in our analyst research portfolio. So I know Dave Coates is our analyst in that space, and he's really bullish on Gold Road Resources and has been looking at Evolution Mining as well.
Okay. Switching commodities, let's go back to iron ore and lithium. I mean, BHP's hanging in there, but
Yeah.
Mineral Resources has copped a caning on. I guess there's a lot of factors going on there with both lithium and also some of their challenges in building their iron ore road. But, Fortescue, it was a $30 stock not long ago. It's now still in that sort of $16, $17, $18 mark. Just looking at sort of the big three, Rio versus Fortescue versus BHP, which way are you leaning at the moment?
Yeah, I think we have a buy on Fortescue at the moment. I will have to clarify that though and get it back to you. But I know for our analysts looking out there, we still have that exposure to China. And until China comes back with material growth and demand for our output on the mining space, it's really going to hamper our results coming out in the new financial year. So while iron ore has been recovering in recent times, we have seen the price recovery for all those miners. They have done it really tough in the last financial year. We are expecting a turnaround in the near future when China's economic stimulus becomes reality and material in the growth front. But also we have the Trump tariffs now causing turbulence for China's recovery. So it's a really tough time there. But given we have seen trade diversification from Australia since China's a sluggish post-pandemic rebound, we have seen increasing results and increasing trade expectations and demand for our iron ore. So that's really going to go well. But looking across the board on our big ones, lithium, I have heard that we're at the bottom of the market now for lithium, and obviously Rio taking over Arcadium kind of signals the way we look forward for lithium and the outlook for an upturn in the market there. Lithium's always going to be needed, and we're just still working through that supply overhaul at the moment. But in the near future, we're expecting a rebound in prices in FY26, FY27. So I do see it plays a critical part in the green energy transition. So Rio, BHP, FMG, you can't really go wrong investing in those big blue chip miners.
Okay, let's move on finally, Grady, to look at also what some of your clients are doing, because you've got one of the biggest retail investor bases, and I'm sure some institutional clients as well. But what stocks have your clients been buying?
Well, in recent times, we've seen the banks shift from buyers to sellers in recent weeks. So that kind of shows the volatility of share prices right now. Last week, clients were selling more of CBA, ANZ, and Westpac, and also selling Telstra Group. They were buying into BHP and CSL, so those bigger blue chip stability stocks that offer really stable returns in a time of uncertainty, and obviously global exposure there. So CSL, the biggest healthcare company on the market, and has a heavy weight in our healthcare and our ASX 200 sectors. So that's been happening. Then we had clients also bought into Fortescue, which we just spoke about, Pilbara Minerals, or PLS now, as they have been renamed. Mineral Resources was bought back into, and Macquarie, as I said. So we're seeing the kind of smaller financial companies or the diversified financial companies rise up the ranks with our investors looking for buying opportunities. But yeah, it's a really interesting time right now.
Any standard, what on the tech side? Because I mean, in the US, it's all been tech.
Yeah.
The big seven had reported well. They've done well as they've sort of markets recovered. Our tech sector seems to be just a little bit slow at the moment. What tech stocks are people buying, and what are they selling?
Yeah, we've seen WiseTech have a big jump recently because of the fundamentals of the company and its leadership position
Mhm.
in the logistics and software space. So, besides the whole political issues on the sidelines, the company as a whole is a fantastically run company, and we've actually upgraded it to a buy rating recently, thinking the recent share price appreciation was very much overdone. Life 360, we've been very bullish on for a while as it nears profitability, and now we also look at the likes of Xero and those accounting softwares that have annual recurring revenue. So when you're looking at those, you want to see contract appreciation and annual recurring revenue rising every year. So those are the ones we're keeping an eye on at the moment.
So it's almost like they've gone from sort of the ones that are just growing, the potential or prospect of growth to the ones that actually demonstrate they've got
Yeah,
solid business, solid revenue, and they're able to sort of, as you say, grow that revenue each year. Companies like Xero and WiseTech, some of
exactly.
the high flyers have gone by the wayside. Is that sort of correct?
Yeah, and we are looking at diversified use of technology as well. Like even in the healthcare space, you look at Pro Medicus, which is a very expensive stock, over $230 per share. But we've actually recently increased that to a buy rating as well because of that subscription model we were just talking about. It's the higher the contracts you win, the higher the subscription model, the way in which you're going to grow your revenue and also bode any storm that you see and weather any storm that you see on a macroeconomic front. So the way in which we've seen the companies do it best and do it successfully in the tech space is through their contract renewals and contract wins.
Yeah. All right. So really some great insights, Grady. Thank you so much. Really enjoyed having you on the Switzer program.
Thanks so much for having me, Paul.
That was Grady Wolf from Bell Direct. Now to talk about the market, a couple of picks, and also what the election result may mean longer term is Chris Haynes. Chris is from Equity Trustees.
Thank you, Paul. Nice to
I
be
guess
here.
we saw what most people would describe as a fairly surprising election result on Saturday night. I won't ask you whether you're surprised, but let's just talk about the impact on markets. Do we expect much of an impact from that result in the market in the coming weeks to months?
I would say no, only because usually, history says that's the case. So I would expect nothing really. It's probably just more certainty of the same, what we've had for the last 3 years. So I suppose that's a positive.
Mm-hmm.
So that's all I would say about that.
A lot of people were worried about a potential hung parliament going into the election. Now we've got at least a majority government. That should be a little bit better for markets, you'd think, in terms of at least on the delivery of policy. Is that a fair assumption on my part?
Yeah, I think that's a good summary. Yeah, I mean, there's obviously bits of the policy which are issues for the economy, specifically net zero. That's probably the most difficult thing, I think. So we have to, at least we know where we're going, don't we?
Let me move on. We've seen Westpac's half-year result today. Most people think banks are pretty expensive. Westpac perhaps disappointed a touch. What's your take on Westpac's half-year result?
Look, it's slightly disappointing. In the land of banks, 2%'s a lot. So there's a bit of disappointment there on the profit. I think the most interesting thing in the result was just the margin contraction. I mean, they have these replicating portfolios which are meant to soften the impact of rate changes. So I think we may have just seen a little bit of a turning point in this result for all banks, as if you strip out that replicating portfolio, there's quite a lot of pressure on margins. So we've had this flight to the banks in recent times, thinking they're perfectly safe, but the margin pressure, and I'm probably talking my own book here, Paul, but the margin pressure is real. So we'll see how that pans out over the next little while. But that's a lot of revenue for these guys to, they need a lot of volume growth there to offset that, and maybe we've seen sort of short-term peak in those prices.
And why do you think that there has been this sort of seeing the banks almost like a safety investment by a number of I guess, the big super funds?
Well, I guess CBA is the case in point. They're almost 12% of the index. So, I mean, there's lots of reasons around that. It hurts when it goes up a lot, and then you want trying to cover your exposure there. So, and also we've had this Trump, flight to safety. People just sort of run out of the US. So there's Asian funds flying into bank stocks, and they're just big liquid businesses that people can put their money in Australia. They think it's fairly, and that's been sort of, very pronounced over the last month. So yeah, it's not necessarily based on fundamentals. So it's just like, that's the best house in the street. We want to buy the best house in the street, and we don't care what we pay for it. And CBA is a great business.
Do you see that a risk of sort of that sentiment changing at some stage? I mean, what would make sort of some of those managers want to sort of perhaps move their funds out of the CBA and look at other parts of the market?
Earnings is everything. All at the end of the day, that drives stocks. So maybe if we see a little crack in the armor of the banks, and it's been a beautiful period for them. No bad debt cycle sort of through this slowdown, rising margins. That's driven pretty good profit growth. So we're now at the time when margins are, looking like they're going to head south again. Plus, there's nothing left in the tank in terms of bad debts. I mean, we're at the low point in bad debt charges. So, I mean, they're just really small changes, but there'll be no earnings growth for those stocks going forward. And you're paying a lot for no earnings growth. So you're paying for CBA 27 times earnings, and you can buy Google and Meta offshore for less than 20 times. So I think, that and I think maybe, every time Trump says something, it's terrible and awful, and often things aren't as bad as, what they initially appear. So maybe that's the other side of the story.
It's an interesting comparison to both Google and Meta. Sort of puts the CBA in context a little bit. Let's turn to a sector that I think that you think hasn't really been firing, at least the last few months, and that's healthcare. What are your views on some of the healthcare and some of the stocks in that sector?
Look, we've got a couple of investments in that space. So Telix for one, which is the radiotherapy and diagnostic business, which is pretty exciting. That's a real long-term story. So I think for prostate, for kidney, for brain cancer, there's some pretty exciting developments there. Obviously, it's mostly in prostate at the moment. And the great thing is they manufacture in the US, and their market's the US, but they also globally. So they're not caught by tariffs, and but we don't know what's going to happen with Kennedy heading up the health system there. But we think they're okay, and they look pretty good, and they've had some good numbers. They got their brain diagnostic knockback, I think last week or the week before, but that still looks okay. It's a small market, but I think the therapy side of the business is pretty exciting, and that's got a very big potential market for them. They're doing well in the diagnostic, but the therapy side of things is pretty exciting as well. So I think that's a great business going forward, and you're not really paying much for the upside in that therapy business. So they're already earning quite good revenue on the diagnostic for prostate. So if we get the therapy through, and then we go to kidney, and then hopefully the brain. The other one is CSL. Obviously, IVIG is really important for immune therapy for people who've got immune deficiencies, and I think there's a bit of a question mark around manufacturing. So we know they manufacture some in the US and some in Switzerland, and there's IVIG flying all around the world, and I think there's a bit of a question mark around that. I think long term that'll be a pretty good. I mean, it's certainly been marked down a lot over the last couple of years, but I think that's got reasonable growth profile.
Oh, a question I get asked a lot, Chris, and always interested in the views of fund managers, is setting up a portfolio, particularly for your kids or grandchildren. If you really think long term, do you have any sort of thoughts on the top sort of 2 or 3 stocks that you might put into a portfolio for your grandchildren?
I haven't got any yet. My kids, my wife makes me do stock tips to the kids once a month, and I try and think long term. So nothing that's nothing sharp that's going to blow them up, but also things with some long term the growth, because I think growth's really important to have in your portfolio. So things like CSL, things like Telix, Telstra as well, I think is a good business, and I think maybe a few of those stocks have been marked back in the data center space as well. So your next DCs and your Goodmans are probably good long-term prospects. I think that's sort of that's interesting, certainly in the pullback in the last few months with, you know, I guess we've been a little bit scared because Microsoft said they were going to reduce their data center spend. But so those things have come back to more reasonable territory. And then, you know, obvious things like, I mean, some of these things have run already, but things like coals are good things to have in the portfolio as well.
Chris, thanks you so much for joining us. Really appreciate your thoughts, and maybe we'll talk to you before the next election. So that was Haynes. He's the head of equities at Equity Trustees. Chris, thanks for joining us.
Thanks, Paul. Thanks for your time. That's
all we have time for today. Don't forget to read more about what Peter thinks and get all the latest insights and information. Go to the switzerreport.com.au. I'm Paul Rickard. I'll see you next week.